CPI was released today and the market responded favorably to the news, only to open and then sell down as the day progressed. But then around that 10 o'clock level, we saw some support kick in, which is exactly what we wanted to see. What is causing these fluctuations? Why can't we find a very simple area to base in? What was with the sector rotation today? Why was it leaning way defensive and then flipped back to certain tech names? What is the most recent move in the last hour telling us? Why this one chart makes Goldman Sachs bullish on equities? Were the Fed minutes that were released today that scary that they caused the sell-off, or was it something else that they're saying that added to the panic towards the end of the day? PPI is tomorrow, and we need to go over that. Let's get to it. Hey everybody, welcome back. In today's video, we're going to go through a bunch of stocks that moved today and what the expectations for those stocks are tomorrow, on top of going through a bunch of macro information, what CPI was, what to expect with PPI, and the correlation between those two, and a couple charts here that are fascinating, and a piece by Goldman that I think we should all be paying attention to. So let's get into it. I think it's important for us to just note that we really didn't go anywhere. I know people are looking at the market, and we sold off today, and it's a concern. S&P's down 40 basis points in the futures today. It's not exactly carnage. Now, there are rotation going on, and we do need to discuss that rotation, and long term it needs to fix itself. But for now, I don't really see the massive problem with today's move. Is it great? No, it's not, because we dropped on actually good news. CPI was released today, and when it came out, core CPI was right in line. Now, core CPI year over year was predicted by a lot of firms to be higher than expected, and it did not do that. Matter of fact, it came in line, which was very bullish. If you look at the CPI year over year, not only are you at 5.2% as an estimate and coming in at 5, you were previously at 6. This is the first 100 basis point drop we have in CPI year over year. And this is really important. Now, I'm wondering if people are getting spooked because it happened so fast, because that is a massive drop in CPI within a previous number, from two readings. It's an absolutely huge move. Now, CPI month over month, 0.1 versus 0.2. You really could not ask for better numbers. But if you take one thing from this video, take this. So here we are back in July, and you can see that you're at 9.1, and you go to 8.5, 8.2, 8.2, and you can just see 7.8, 7.1. So there's a decent drop, 60 basis points, 6.5, 6.4, 6, and then boom, 5. So the question might be, is it dropping so fast that it's starting to scare people? Now, that could be the first thing that we're seeing, but if we drill into when this was released, we can see very clearly what happened right here. And we just ripped, came back down. I used this line as a demarcation to show where the open was, and you can kind of see the battle throughout the day there. But the purpose of me showing you this is, this was very well received. Now, what's so fascinating to me is that PPI is tomorrow. PPI, when PPI comes out, that is the producer's price index. And here are the estimates. So you can see year over year, 3.4 versus 4.4, expecting a decrease, an increase from the previous month over month on core, and your month over month, you're expecting an increase, and year over year, you're expecting an increase. But what's interesting is this 3% from 4.6 and then 1. So you're expecting an increase up here, but a decrease down here, which doesn't really make a lot of sense. But what really does with these numbers? The point of this is, there's very little chance, and I say this going into tomorrow, anything can happen. We all know that. But there's very little chance of these numbers being that bad, considering that CPI was where it is. So if you understand what CPI is, and that is the consumer price index, that's what we pay for things. And if you think of it from that perspective, you can see our level right in here too. Let me point this out while we're talking. So you see this level right in here? Where'd you stop? I mean, it was perfect today. And you were just wedged right into our support and resistance lines. And that's why I always mark the open. Always mark the open when you trade, because it's just so easy to see that as a demarcation line. It's really, you always want to mark those levels before I get into why PPI should be weak. And you always want to mark where you have events. So in other words, you had an 8:30 event. You want to mark what the market did there. If you don't look at the futures market and you do it with the S&P, there's very little wrong with that. You can see how we're doing that right here. You just have to understand that the chart's going to look a little different. That's all. But The rally tried to get through, couldn't get through on the S&P, pulls back, can't get through again. Pretty clear distinction on what's going on there. And then, of course, you have the gap fill, and that always is a support and resistance area, and you can see the break. Now, the issue with CPI and PPI and why this is so important, and we went over this on the live stream a little bit today, is producer price index. It's very, very rare that they're going to spend more to develop a product on the PPI than CPI. Right? They always pass it on to the consumer. It was really interesting today. You were just unable right after the Fed minutes to gain any traction. And I think that is based upon a couple things that were said. Now, this is the first time that we really have heard the Fed say that they expect a banking crisis to cause a recession. And that was talked about in the Fed minutes. So clearly they're saying one thing and they believe something else. This is very different than what Powell's been saying, that he thinks that it can be averted. Now we're in a position where they're suggesting pretty clearly that they think it's possible. And it's definitely something that we need to watch. We're seeing that at the investment banks too, where they are coming out and saying that they are seeing a crunch in the amount of M&A in certain fields, and they don't think that the tightening lending standards are going to help. But if you just look at the key points here, and this is just very simple, they just took a couple of the glaring points in my opinion, but fallout of the U.S. banking crisis likely to tilt the economy into recession later this year. Meaning you're going to have tighter lending. If you have tighter lending, less money goes out, more business gets, or less business gets done. The cost of that business obviously continues to decline, meaning wage growth declines and productivity declines. Federal Reserve gave FOMC minutes presentation about repercussions of Silicon Valley Bank and other tumult financial sector that began in early March. Though Vice Chair Michael Barr said the banking sector is sound and resilient, staff economists said the economy will take a hit. So you have some conflicting data going on there. At the same time, we have Yellen speaking, saying that the economy is strong. So we're all in agreement then that the S&P should probably come in, right? Well, not exactly. So here in front of us is a tactical flow of funds. And what they're saying is look past the fundamental of CPI and payrolls. Just look past it for a moment is what they're saying. And what they're saying is if you look at quarterly earnings for 23 versus 22, we're expected to be down 7%. That is an absolutely huge number year over year to be down. And think about it. If every quarter was down 7%, what that would mean on the year for earnings, how bad earnings would be. To put that in perspective, this is the largest year expected decline since the pandemic. And you can just see the drop off during the pandemic, and you can see roughly where we are right now and what they're predicting. And this is very different than what we've been dealing with before. Now, this is not good news. So why do they think that this could possibly lead to a bull run? So let's hammer a couple of these points home. Removing 2020, this is the largest expected corporate decline since 2016. The number one question on their desk this week is the bar for corporate earnings already so low that it's possible for corporate to beat low market expectations. Now, we already saw some of this with companies that predicted that they were going to have really bad quarters, and they had what we refer to as kitchen sink quarters, and then they came out and beat those estimates. And what we're seeing is the following, or what he is seeing at Goldman is the following. Positioning is very short. We know positioning is very short. We're trading the market every day, and everyone has the attention span of a gnat right now. We all see it. Fundamental investors are underexposed given low net hedge fund exposure. Fund of flows technicals remain favorable from CTAs, tax deadlines pass, and corporate returns to open the window. Sentiment remains bearish, and the joy of missing out turns back into FOMO. Liquidity is the highest level of 2023. There is so much money on the sidelines right now, guys. We went over this in yesterday's video. Now, if you look at his number one point is that equity macro liquidity has increased substantially over the last 2 weeks. And top book liquidity is the highest level since December 27th, 2021, which was about 18 months ago. Now, this part's really important. Top book liquidity has increased 9-fold from the lows, with risk transfer only at 2 million. The cost to sweep the order book has declined by 57%. This is what you're seeing today. Like when the market moved, see how fast that those moves were today? This is one of the reasons behind that. Now, where would this demand come from? There's going to come from two spots. So what they're talking about is discretionary shorting. So you basically have net non-commercial S&P E-mini future is short by this amount of contracts, 321,000. This is the highest short level since November 8th, 2011, 11 years ago. Remember this date because we're going to talk about it. November 8th, 2011. And you can see right down here, and you can see where we are now. And this is the most net short that they have been. We are more net short now than we were during the pandemic. And you have to go back 11 years to November 8th, 2011. Now I'm going to wrap it with this because you're saying, where's the buying coming from? Who's going to buy? Well, the buying is going to come from, number one, the people that are short. They're going to have to cover. They don't have a choice. You just can't stay short forever. Eventually, you have to buy in, right? Futures roll over, etc. So we all know quad witching, triple witching. It is the max corporate blackout right now. So U.S. corporate blackout window is from now to April 28th. As a reminder, corporates have the authorized record of $360 billion year to date, which is up 11% year over year, which is also a record of corporate buybacks. And we can take a look from 05 and see right in here that this is the highest level of buybacks that we have on record. Now, to put this all in perspective and wrap this home, right here is the last time that we were that net short on the book. So when I said November 8th, 2011, that was it. You can see from that date on what happened to the market. At the same exact time, you did not have $360 billion worth of buybacks that were looming. That did not exist here. They were still fighting to keep their companies open at this point. So that was not in existence, 360 billion. So the idea of sell in May and go away may be a little different this time. You know, if you could all comment in the video, I'm really curious about what you would prefer. Would you prefer that I do the Qs and the S&P, or would you prefer the futures market? It really doesn't matter to me. It's 6 1/2. But I do find sometimes when I talk about the futures market, people ask me to refer to the Qs as well. And I'm going to just use the Qs right now. But you're sitting right at 313. You're not really breaking here. It doesn't matter to me which one I use, candidly. I look at all three during the day. But you want to just watch this key level up here. And it doesn't matter that you're up a little over it or down, because you're going to look at this more as a range than anything else. And I'm really focused on 313, quite frankly, in that little window right in here. But if you could comment on that, on what you would prefer me to use, that would be great. So before I get into the next portion of this, I just want to focus on this. Nothing's broken. Okay, so we have a 9 EMA here that I'm just leaving as a mark. Yes, you're below it. Is that good? No, it's not good. You haven't been below it since March 13th. And now you're below it, going into good news. And as we always say, we had good news today and we sold off. Okay, we had good news today with CPI and we sold off. So we have to realize that that is bearish sentiment, and the same exact thing could happen tomorrow. Now, the beauty of this is that PPI usually is good following CPI. So if PPI bids up and you want to short for a very short period of time, and I'll show you a couple ideas here in a moment, then that's what you want to do. But you want to do it into the rally. You don't want to short today hoping that PPI is bad tomorrow, and then you step into, who knows what tomorrow morning. You'd rather come in and be prepared, right? Instead of just guessing and throwing things against the wall and see what's going to stick. But you can see pretty clearly what happened here at the end of the day, right? Now, we've been focused on this last hour chart for some time. We come out here and this goes out 20 years. For those that are new, the last hour shows you what happened literally the last hour, and they assign a positive or a negative to it. Now I'm going to zoom in for 10 years. And what you're going to notice is a huge difference here. You're going to notice that we were hitting trough levels for a period of time where no one was buying at the end of the day, to now we are breaking out. And I think that there's an important distinction that we need to see here. Now you have to excuse my childlike handwriting, but if you came across here, you just draw that line straight across as best we can. So you're kind of wonky in here, but you see where I'm going and how we're breaking out here. So you kind of have to take a look at this and go, okay, I see that breakout, and this really is not following up here, is it? So what are we going to do about that, or how can we change that or affect it? Well, I'm not so sure that we can, but what I do know is that when we are declining and we're falling off a cliff like we did here, that is pretty much telling us that this is not sustainable for a long period of time, right? You can see the divergence right there. So I would argue that if the negative divergence is valid, which it obviously was, it took months, but it was valid, and we saw that institutions were selling, eventually this will be valid as well. And this fits right into exactly what Goldman was just talking about in those articles. There's another article that I can tie into that article, and if you would like me to go deeper into that subject matter, just comment in the video below and I can. Now, I understand, and the question's going to be, this is all great, but what about tomorrow? And that's valid. So what we're going to do is just look at the last hour over the past 3 months. And I'm not crazy about this. So if we take a look at the last 3 months, and this was the high, right? And that just happens to correlate exactly with roughly where the high was on the market. And you are not able to get over that, right? You see how you're just trying, boom, boom, boom. Can't, again, you watch my childlike handwriting. You cannot get over since that happened here on the S&P. But at the same time, what's happening here? So when you start looking at it from that perspective, and please don't comment on my childlike handwriting, but you can see what I'm getting at here, right? And so as this is going up, well, this is not working. And what that's going to do is that's going to create a lot of pain for somebody. And I still believe that that pain can be on the long side. Does not mean that it's going to happen tomorrow or the next day, but I do think it's out there. It was one thing when the 2-year was around 5%. You go out there and you buy bonds. You're still buying them at 3.96, but you're seeing these huge moves in the bond market now. For some time, we were talking about TLT in the 20-year. We couldn't figure out why it's not breaking. It's still not breaking out, but you're having these vicious moves. And as long as this continues, you have that level of uncertainty. Well, you're going to see the equity markets jump around the way that they did. And we are seeing them jump around, but we're not seeing complete deterioration, but we are seeing weakness. So the number one thing that happens in markets, if you take nothing else, remember this. The number one thing that happens when you have markets that are sustainable and they are going to rally is that the Nasdaq outperforms the SPY. That is the number one thing that happens. Now, if you look at this rally here, you can see how the Nasdaq outperformed the SPY. And then you can see in here from September on, we just kind of bonked around where they had little battles. And this became pretty clear. And you can see like your little demarcation lines right here and how that was pretty telling that, you know, the relative performance, even though the Nasdaq was going up, the relative performance was fading, and then it's just faded. And now we have the single greatest rally that we've had. Now, we tried to break that neckline. We were unable to. We're having trouble breaking it again. And I think that that's worth noting. Okay, so that what I'm getting at is what we just went over was a bunch of information about how good things may look in the future in a couple weeks, a couple days. We're not sure. We never are. We'll know more on Friday after bank earnings. But what we do know is that we just attempted to continue the rally in technology, and we have no leadership in technology that can do that. Some names look like they could push, but the majority we're going to get to now. So if we take a look at the SOXX, and we just look at the 440 level, and we're just going to mark that off. I'm going to mark it right around here. Get up to that. Let me take off this little move over here. That sometimes that magnet gets in my way, but I want to show you the 440 so you can see this coming straight across and just how glaring this was. So here's our level right in here that you're fighting, flips, fighting to get through. And once you broke it back here in April, you've been unable to get above it. Now, you did have a new 52-week close on the SOXX. Just because I couldn't get through it once does not mean I can't get through it again. But what we do have to do is look at what is actually happening, not what we want to have happen, right? But we have to look at what's happened. And we have this trend line right here. So can we come down to this trend line? Absolutely. We have a minor trend line sitting right here. We all see it, right? And we broke that today. Okay, so we have the minor trend line, and when you start breaking these trend lines, you usually go to the next one. So that is a concern. Now, if I am to very simply just go here and clean off these drawings, there is something else that we should be focused on here before we get into the individual names. And I think it's important. So if you take a look at this, we're going to blow this up so that you can see it. You can see very clearly a couple things. Number one, right in here like that. We're going to make it up. We're going to do better than that. All right. So right here, you see that gap? Hopefully you see that gap, and there it's right here where you have a little gap there. And then you have a little gap right here as well. That gap, okay, that's a continuation gap. That's exactly what you want. That shows you that you have so much buying. Okay, there's so much buying that they're gapping it up. Matter of fact, you even have another gap up here that you could say, but it's not an island because you have this little piece up there. So that's not really technically an island. But if we take a look at what's going on over here, we're getting another island. Now, the problem with this island right here is that you could actually argue that this is a left shoulder, a head, and a right shoulder, right? It's not the best, but it's definitely there, and it's definitely worth noting. So if we look at this and we go, okay, well, that's not ideal, right? And then if we broke that neckline, and we just talked about where the neckline was when we were putting in our trend lines, we need to watch this tomorrow. And this ties directly into the first name that we need to watch. So we need to watch NVIDIA tomorrow. Now you can see these gap ups. This is exactly what you want to see. We know there's a massive trend line up here. We're all aware of it. We've all been looking at it for a period of time. I've been discussing it ad nauseum, hoping that we could break on a good CPI, which we did have, and we just did not motor. But you're looking at that 288 was what I've been looking at and thinking that we could get to. And we're just running out of steam up here. Maybe we need a little bit of a pause before we push. I'm not really sure. Time's going to tell. But there's some other technical things here that, frankly, I don't have the time to get into that are telling us that this is not going to be great. Maybe we'll go over them tomorrow in a little detail if you guys want in the live stream pre-market. But you see that right there? So now we have this gap, and that's just not great, right? 1, 2, 3 up, breaks low, closing at the low, and now you're going into PPI. And now the hope is, here we go again, hoping that that's going to be good. Now, if that's good, that's great. But if we crack here, then yep, you could see a little short-term weakness here in the market. That is a possibility. And you are starting to see that spread a little bit. Today I shorted Tesla, and I did pretty well with it, but the premium on the options was so great that it made absolutely no sense to stay in the puts. But you can see that's a reversal, and now you're closing at this low. And now we're at a point where if you start thinking about it from this perspective and saying, okay, well, here we are in Tesla, right? And there's our close on the day. Well, when was the last time we closed here? We haven't closed back here for a month. So you've not had a close this bad for a month. That's not where you want to be. You don't want the lowest close in 30 days. That's not where you want to be. That's a problem, okay? And you can see that that's right on the top of this chart, right after you have this breakout that failed. So you have these people that bought the breakout, then they got trapped underneath of it, and then you can see what's happening right here. It's not where you want to be. Names that are just very simply not caring about this are Meta. Okay, Meta was up on the day, even though the Nasdaq was down 1%. Microsoft does not really care. So let's clean this off for a moment and get rid of this so we can view this a little bit cleaner. But Microsoft, it just does not care. Now, will it care tomorrow? We're only going to know that tomorrow. But you look at these levels and you look at the gap fills and you look at where it's been. If you were going to break down, today's the day. So if this isn't going to get it down, what is? All I see is us holding the opening price of that breakout, which is exactly what you want to see. And I don't see massive breakdowns here. I'm going to clean up these levels again so we can talk about it. But I don't see massive breakdowns. All I see are these levels that we're getting to, which were breakouts. And then we're retesting those levels. Now, could that get ugly tomorrow? Absolutely, that could get ugly. That could most certainly get ugly tomorrow, right? But we don't know that yet. So we're just going on the premise that, oh, it's going to get ugly. We don't know that. And so what we have to do is we have to understand where we are and go, yep, well, there's a DTL there. Okay, well, maybe it's going to go sideways to down before earnings, which is coming out next week. Or maybe it's going to be weak before earnings. We just don't know. What we do know is that there's constantly opportunity. So this was something that we were batting around today. And I've been playing with this for a couple of days. I was waiting for it to move, and it finally did. I've just had a small position in it, and I was just waiting, but this was a pretty simple setup. You can see every time that we tried to break down, it just refused. It refused here. I thought we'd pop and retest this high. I never expected it to get this goofy. I mean, obviously, I'm glad I did. But you're seeing opportunity. This was a great example. We talked about this stock We're in this from the newsletter. If you don't get the newsletter, link in description, but we've been talking about this stock and we've been in this since $24. It gaps down on some silly news. All of a sudden, you just have net buyers all the day and it fills back up. So there's $3 there on a very simple trade that has nothing to do with what's going on in the world. Just a very simple trade. And if you're struggling right now, these are the kinds of names you want to look at. And I don't really even need to put moving averages in or anything. So we've been in this for a while. They had really good news come out on one of their drugs. It was a little bit better than expected. And then we have this huge move. And now today you were hitting all-time highs. And it's not just one name, it's several names. So here's APLS, another one that we're in, and hit all-time highs today before selling down ahead of PPI. So if you're struggling, I would start looking at the one-offs. And I'm going to leave with this. I would be a little concerned about Bitcoin and the fact that I didn't break through. I'd be a little concerned, not a lot, but you want to just watch all this nonsense right up in here. I'm going to use the open up here, but I do want to go through this because I think it's important for everybody. See all this nonsense right here? We have to get through that. And until we get through that, I would not be a huge buyer in here. We played around with Arete today, made a little money the first time, hardly anything the second time, and it just couldn't get out of its own way. I have a position in MicroStrategies, and I will say this, we are seeing institutional sponsorship come in. We're up about 30 bucks in it. $24 in it right now. What I like about it is that I've got institutional sponsorship and we're hanging in here. We're not breaking down. So that's it. This went a little longer than I thought it would, but we covered a lot. If you are struggling, please watch this video on day trading. I've got nothing but really good reviews on it. And I'm leaning towards the next video being on swing trading or on option trading, and comment below on what you would rather see a tutorial on. Have a great day, everybody. Trade to win.